Hi, and welcome to fourth quarter 2021. I'm Allie Swafford, President of Prosperity Partners Wealth Management, and today we're going to talk briefly about will tax law changes increase your taxes? That's a good one. Will you be paying more taxes in 2022? Well, let's ask that question another way. Since politicians have taken aim at high earners, are taxes going to rise for the wealthiest taxpayers? Clients usually say, well, how could that affect me? Or will I be ensnarled by Congress's definition of wealthy? Well, if proposed changes in the tax code that passed a House committee are enacted into law, those that are wealthy as defined by lawmakers will likely see their taxes rise. The major provisions include the following: raising the top federal tax rate from 37 to 39.6%, levying a 3% surtax on income higher than $5 million for single and joint filers, raising the taxes on dividends and the long-term capital gains tax rate for assets held over 1 year to 25%, up from 20%, for individuals earning more than $400,000 and couples earning over $450,000. Placing new limits on those who have large retirement account balances and putting new limits on the QBI deduction for pass-through firms. Well, these proposals are a long way from becoming law, but are winding their way through Congress. The Senate may have its own set of proposals, which would require both legislative bodies to forge a compromise before a tax bill lands on the president's desk. Moreover, a sharply divided Senate seems likely to pare the $3.5 trillion in proposed spending, assuming legislators in the House compromise on new outlays. If new spending is reduced, smaller tax hikes could follow. While a wait-and-see approach may serve some folks well, we understand that planning for any changes reduces the odds of an unwanted surprise. Here are some just general guidelines, and we understand that your situation is unique, and we would be happy to entertain any questions and tailor our recommendations to your needs. As always, feel free to consult with your tax advisor on any tax-related question. The proposed increase in the top tax rate and surcharge on income over $5 million. A couple filing jointly that has $600,000 of taxable income here in 2021 will see their rate in 2022 go from 35% to 39.6% a year. If the proposed changes are enacted, 4.6 percentage points or $6,900 in increases in taxes on that extra $150,000 of income. However, there are ways to minimize this tax sting. Well, consider shifting 2022 income into tax year 2021. It would be subject to this year's lower rate. Also, look for ways to defer expenses and deductions that you might normally incur in 2021, push those into 2022. Maximize contributions to tax-deferred savings and retirement accounts. If you itemize deductions, charitable contributions will reduce your taxable income. In addition, municipal bonds, which are exempt from federal income tax, will become more attractive if a higher marginal tax rate is enacted. The proposed 3% surtax on individuals earning over $5 million would effectively raise the top tax rate to 42.6%. Now, this won't hit very many taxpayers, but be aware that maybe the sale of a business or a large asset could push you over that threshold. Also note that this surcharge is separate from today's 3.8% tax on net investment income. A higher rate on dividends and capital gains tax is being considered. Now, this one does hit most of our clients. As proposed, if a capital gain is realized on or after September 14th, 2021, individuals earning more than $400,000, couples earning over $450,000, will pay a top rate of 25%. The same would hold true with dividends. Now, there are a few narrow exceptions, but otherwise it may be too late to incur a long-term capital gain at 2021's lower rate. Now, you may consider deferring gains, as an unrealized capital gain would not be subject to taxes, or rates may decline again in the future. As we commented up top, much depends on your individual circumstances. There's going to be a new required minimum distribution requirement for individuals who have high income and large accounts, retirement accounts, regardless of age. Now, once again, at this point, we have few clients that have in excess of $10 million in their retirement account. However, if you are one of those folks, you need to consult us on what you might want to do. For our business owners, if you're self-employed, the House proposal limits the deduction to $500,000 for joint returns and $400,000 for individual returns. Once you've exceeded the cap, additional amounts will be disregarded. Now, there's some things that are left on the cutting room floor. Lawmakers in the House have not proposed taxing unrealized capital gains at death, as had been initially proposed by the President. Also, the step-up in basis for an inherited asset is not in the current House proposal. But one proposal being floated out there is to reduce the estate and gift tax exemption to $5 million, indexed for inflation. Tax reform in 2017 raised that limit to $11.7 million, and of course then 23.4 for couples. So most of our clients were not then thinking too much about estate taxes. With this lowered exemption to $5 million adjusted for inflation, which would turn out to be close to $6 million, this could become an issue. So please talk to us or your attorney and see what might need to be done in your scenario. A lot of people said, well, what is it about September? September has historically been the worst month for stocks, according to the St. Louis Federal Reserve data, measuring the S&P performance over the last 50 years. If you're wondering whether the trend has abated in recent years, the answer is no. Over the last 10 years, September performance has been substandard. While analysts have offered various explanations, no one has pinpointed the reason we sometimes see seasonal weakness after summer concludes. Look no further than the key index returns. The S&P fell 4.8% in September. It was the first monthly decline since January and the worst decline since March 2020 when the lockdowns began. Of course, the S&P was not the only one affected. The Dow was off 4.3 in September, NASDAQ 5.3. There just was nothing that was not affected, whether it was international, whether it was even bonds were down a negative 0.9. So, peaking a new record on September 2nd, the broad-based S&P began the pullback, and there's a number of factors. 4.8% drop in the market is not what we would consider a correction. 10% is normally that number, and we normally see 2 to 3 of those per year. Well, what was behind the sell-off in September? The economy is not contracting, and a moderation was expected after QT's 6.7% annualized growth rate. But the slowdown has been more pronounced than expected. The Atlanta Fed's GDP Now model, which incorporates economic data that impacts GDP, suggests that Q3 growth is tracking at just 2.3%. Now, a lot of data from August and September is not inputted into that model, so there'll be some revisions. While profit growth has soared coming out of lockdowns, a more pronounced moderation in profit growth may be on tap. Well, why is Q3 disappointing on the economic front? Well, the spike in COVID cases is causing some hesitation in industries that are dependent on face-to-face transactions. But there's good news on that front. The CDC says cases have slowed recently, and we'll see how this continues to play out later in this fall. While bank deposit data from the St. Louis Fed suggests consumers have plenty of spendable cash in reserve, the influx of new stimulus money has dwindled and spending has slowed. We're also seeing stubbornly high inflation in some industries as supply chain bottlenecks aren't fixing themselves. Here's a Wall Street Journal story that came out late in August, and consider this title: "Why is the supply chain still so snarled?" We explain with a hot tub. Utah manufacturer Bullfrog Spas depends on a complicated network to bring materials from across continents and oceans. The pandemic put it out of whack. Well, that sums it up. Out of whack is true for many manufacturers. Jerome Powell noted at the end of September, bottlenecks and shortages of key raw materials are not getting better. In fact, at the margins, they are apparently getting a bit worse. Severe labor shortages, supply chain problems are crimping profitability, limiting sales, raising prices, and hampering economic growth. So investors, take note. An uptick in bond yields near the end of the month also dampened sentiment. While yields remain quite low, they ticked higher after the Federal Reserve took on a slightly more hawkish tone at the September 22nd meeting. These are probably the biggest reasons for the pullback in September. Not to be a Debbie Downer, but let's look at a few. The debate over the debt ceiling is taking shape. The U.S. Treasury has said it will run up against the current debt ceiling on October 18th. That means it can no longer borrow funds for operations, and the U.S. would default on its debt unless Congress extends the ceiling. As Moody's Analytics reported, the debt ceiling will be raised. Not doing so would be catastrophic for the economy, so this is an extremely low probability event. Well, we've seen this drama play out before. The lawmakers avoid sailing into uncharted waters. Still, this causes everyone anxiety. China's largest and most indebted property developer is on the brink of bankruptcy. While Western financial exposure is likely limited, a disorderly default could create big problems for the world's second largest economy. Finally, an energy crisis is brewing in Europe. While natural gas prices hit new highs in Asia, they are running about 6 times what they were at home. The U.S. isn't directly affected, but these are costs that may get added to manufactured goods or could restrict output, adding to supply chain woes. Well, we're overdue for at least a 10% correction. We know that these tend to be unpleasant, but they are part of the investment landscape. With all but the most aggressive and risk-tolerant investors, we recommend a healthy portion of fixed and buffered investments. A mixture of these types of products can smooth out returns. We don't see the extreme highs when stocks are rising, but mixing in fixed income and buffered products reduces your risk on the downside when equities turn lower. As we've noted in the past, stocks tend to take the stairs up and an escalator down. If we are headed towards an overdue correction, pullbacks tend to be short-lived. You've heard me say more than once, put on your seatbelt, we're going for a ride. I trust you found this review to be helpful and informative. Let me emphasize, it's our job here at Prosperity Partners Wealth Management to assist you. If you have questions or you'd like to discuss any matters, please feel free to give me, any one of the other advisors on our team, a call. As honored, as always, we're honored and humbled that you have given us the opportunity to serve as your financial advisors. Have a good October, and don't forget, put on those seatbelts.